Coming up, the Reserve Bank leaves interest rates on hold, China injects some economic stimulus, and the supermarket fallout continues. That's all next. It is your daily 10-minute business and finance news wrap for this Tuesday, the 24th of September 2024. The Australian share market fell today by 0.1%. We'll have the details with Scott Phillips from the Motley Fool in a few moments. But first to interest rates, where the RBA left official rates on hold once again at 4.35%. With the details, I spoke with Devika Shivadekar, an economist at RSM Australia. Devika, first of all, why did the RBA leave interest rates on hold?
It's no surprise though, Ricardo, because we are aware that unemployment rate, particularly the labour market, has been quite tight, and unemployment rate has been trending at the 4.2% level for a while now. And employment growth changes have also been quite significant. Plus, as we are all also aware, the RBA is now focusing more on core inflation rather than headlines. So core inflation has been coming down slightly slower than how it would like to see it come down. So given all these factors, I think the RBA is right to really stay on hold today.
Let's break some of that up. Are there still risks for an increase to the cash rate? I mean, the RBA said today that it's still not ruling anything in or out, and it offered a list of reasons, like you mentioned, that tight labour market at the moment, and also productivity. That productivity is still at 2016 levels. What does that suggest about the direction of rates? Is a rate rise still a potential, or does it at the very least mean an interest rate cut will be further delayed?
I think a further delay in interest rate cuts is probably a better option from where we are today, particularly given that our growth has been quite subdued. And I think the RBA will be mindful of the risks that consumers face as well as businesses when it comes to increasing rate rises once more. I think the RBA doesn't want to go down that path because it's very particular about staying on that narrow path where it is able to not destabilize the economy, but at the same time achieve its mandates. So delaying the rate cut is probably what would be its preferred choice rather than increasing the rate rise from today.
Is it fair to say that this time around it stressed the importance of focusing less on the headline rate of inflation and more on the core or underlying rate of inflation, and why?
I think over here, RBA is mindful of what impact subsidies are going to play in bringing headline inflation down, which could potentially show that it's artificially coming down once all the rebates and all the fiscal subsidies outlined in the federal budget start getting captured in the data. Whereas underlying inflation or core inflation, as you say, strips out that volatility. So the RBA is actually right in focusing more on core inflation than headline numbers, because that is where the real price pressures lie, and that is what captures most of the services sector-driven price pressures in the economy.
So is it fair to say then that the next move in interest rates will more than likely still be down? When and what do you think would need to happen to see that rate cut?
Interesting. So, well, I'd like to hope that the next move is down, although I think we shouldn't expect a move anytime this year. I believe the first quarter of next year is when the RBA would be in a more comfortable position to bring a rate cut, simply because it will have visibility on more data. We are going to get the third quarter CPI inflation data end of October. So that makes the November and December meetings quite live, actually. But again, since the federal budget subsidies are injected into the economy, I think giving the economy at least 6 to 7 months to absorb those subsidies and see what impact it has makes more sense. So wait and watch approach, and pushing the rate cuts perhaps to the first quarter of 2025 makes most sense.
What about international factors, right? We've seen a rate cut from the US. We know that China cut some rates earlier today. To what extent has that opened the door to further rate cuts around the world and Australia, or does the RBA say, hey, we don't even care?
Honestly, I wouldn't say the RBA doesn't care. It definitely does care, but doesn't care enough to go in a lockstep with what the US Federal Reserve is doing, or maybe any other peer global central banks are doing, simply because our economies are very different. They are operating at a very different level to us. They, in fact, hiked a lot stronger and a lot faster than we did. And to some extent, most of these countries had already baked in a potential downturn, economic downturn, and a sharp rise in unemployment in unemployment rate. Whereas in Australia, we're trying to manage that. We're trying to get that balance, which means that our interest rates were raised a lot lower than what the other global central banks did, which makes sense that we wait a bit longer and we go down a bit slower because their economies have responded a lot faster than what we are seeing in Australia.
And for the salaries was to show the range.
That was Devika Shivadekar from RSM Australia, an economist there. But what does it mean for the share market? Well, the ASX 200 did fall today by around 0.13%, 8,142. With the details, I spoke with Scott Phillips from the Motley Fool. Any indication of what the markets are now thinking when we will see a rate cut?
That's a very good question. I haven't seen repricing yet, mate, but previous to now, and again, the market had assumed there would be no cuts, so no reason to expect anything different, is 4 drops next year, 425 basis point moves downwards next calendar year. Unfortunately, that's 3+ months away. In fact, probably more. February or March is expected by the bond market to be the first cut, as I said, followed by 3 reasonably evenly spaced throughout 2025.
What about, though, the Australian dollar? It's been quite strong as of late, still above 68 US cents. Is it interest rates that's really driving it? Because it certainly can't be commodity prices, because that iron ore price is down quite significantly.
Yeah, you're absolutely right. And look, you never can know for sure, but you can kind of infer on these things. And yes, it does absolutely seem it's all about interest rates. In fact, during the trading day today, it hit a 2024 high, not an all-time high, a 2024 high for the dollar against the US. Look, yeah, it's exactly what's going on, right? We've got every other major central bank around the world having already cut rates. The RBA saying, nope, higher for longer, particularly against the US with that supersized rate cut last week. That seems to be almost entirely what's driving it higher. A little bit of extra demand for China. Some decisions made today and unveiled to stimulate the Chinese and prop up the Chinese economy will also help, given Australia is often seen, the Australian dollar is often seen as a commodity currency itself.
Yeah, can we go into that with a bit more detail? Its central bank today announcing some broad monetary stimulus and property market support measures, cutting some interest rates there. What's that saying about its economy and implications for Australia?
Yeah, it's fascinating, isn't it? I mean, we know it's always partly economic and partly political, but we know the Chinese economy is under a bit of strain. The iron ore price you mentioned is down because largely there's stockpiling of steel inside China. There's simply not the throughput required to have our iron ore continue to grow at these sort of levels. So you've got the Chinese economy, I'll say faltering, mate. Look, again, any other country in the world would kill for its growth rate in percentage terms, but we know that China has to grow at these sort of rates just to stay still. The urbanization, the population, the challenges it's got economically, it needs that growth. And so it is some sign, I think, in keeping with what we've seen around the rest of the world. There is real concern about a slowdown of economic activity in the rest of the world through the end of 2024 and early next year. The US has got in front of it last week, China doing the same thing today.
Let's talk about our share market. Again, Coles and Woolworths in focus, shares continuing to tumble following the ACCC's action on alleged misleading discounts. How are investors feeling about this sector?
This is really interesting, mate, because normally speaking, these sort of fines are considered the cost of doing business. I think investors are looking at this and realizing it's both an economic and frankly a political hot potato. We know the government is desperate to pin some of the inflation blame on someone other than themselves, and that feels like Woolies and Coles being the bad guys. Certainly plenty of public opinion too, because where do we see price increases? Where do we see inflation? At the pump and at the till. And so it's going to be a continued move. Look, again, the financial penalties aren't that bad. Again, I say that, tens of millions of dollars probably, but in the context of their profitability and their market cap, not meaningful. What comes next potentially in terms of increased regulation? Maybe the supermarkets have to respond by making, frankly, less money, lower profits. So the market's a little bit concerned that might be the implication. That's why we've seen share prices fall for a couple of days in a row. And
finally, where do you see the opportunities for investors at the moment?
It's getting tough right now. The market's at or near all-time highs, and no particular sector at a top-down level looks particularly wonderful or obvious. It's kind of a stock picker's market, a phrase I really hate, but it is that sense of trying to find the undervalued stuff. Look for the retailer the rest of the market's missing. I mentioned tech before as well. I still think there's big opportunities there. The tech boom we saw post-COVID disappeared to a massive hole for a while. I think there's going to be plenty of opportunity there. And in hindsight, we'll look back and think that might have been a good place to at least selectively go shopping.
That is Scott Phillips there from the Motley Fool. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial